Hello, this is Will Allen with Sentara Capital. In today's market update, we are going to take a look at the blockbuster jobs report from last Friday. We're going to look beneath the hood to see just how strong was it really. We're also going to look back at the Federal Reserve, who 2 weeks ago cut interest rates for the first time this cycle, and we're going to look at what the market has priced for further rate cuts. Let's dive into it. All right, now before I get into this market update, just a reminder to like and subscribe, turn the notifications bell on, and if you have a friend or family member who's not getting market updates from their advisor, go ahead and forward to them. I appreciate it. All right, today's market update, we are going to start with last Friday's blockbuster jobs report. And if you didn't hear the news, for the month of September, the economy gained 254,000 new jobs. This was versus expectations of 150,000 new jobs added. Not only that, the previous 2 months, job gains were revised higher by an additional 72,000 jobs gained. Now, why this matters so much is that it has been common over the last 6 to 9 months that when jobs reports have come out, the previous months have been revised lower. And if you remember, back about 2 months ago, there was a scenario where the BLS revised lower the previous year's job gains by over 818,000 jobs. So this has been a trend that has been taking place. So it was notable that last Friday we got the previous 2 months revised higher by 72,000 jobs. So when you add that to the 254,000, over 325,000 new jobs added by this announcement. Now, we went under the hood because we said, all right, let's dive deeper and see how good is this report really. And the first thing that I want to mention is we always look at the construction industry. We've talked about in videos in the past how important the construction industry is to the economy. And 25,000 jobs were added in the construction industry last month. But we also have a chart that I want to put up that looks at annual growth in U.S. payrolls since February 2020 on average. And if you look at that, you will notice that the construction industry has had gain of 1.9% per year in jobs gained. And if you look, that leads all industries. That is very positive to see that that industry has done so well. And so what can account for this? This is residential homes being built. This is commercial buildings being built. This is also hospitals. And you have situations where you have electric vehicles are getting very popular, as you know, and a lot of battery factories are being built all around the country. And so when you take all of this into account, that has fueled demand for construction industry for employees, and that has been a big boost to the economy. Now, I do think it is notable, speaking of the 254,000 jobs added last month, to take a look at the monthly job gains over the last 12 months, because what you will see is that late in 2023, early 2024, you had very strong monthly numbers. You can see 310,000, 256,000, 236, 310,000 in March. Very, very strong. But notice a weakening over the summer where you had mixed in there only 108,000 jobs gained, 118, 144. But notice with those 72,000 jobs added in July and August, the upward revision, now those months look a little better at 144 and 159. And then last month, 254,000, that number went up. That is very positive. Now, these numbers can be revised in the months to come. So we are going to look to make sure they aren't revised lower in the future months, but it's a good trend for sure. All right. If you look deeper in this report, the unemployment rate came down from 4.2% to 4.1%. And if you look at the unemployment rate over the last 3 years, that you see this got as low as 3.4% in January and in April of 2023. It started going up. It peaked at 4.3% back 2 months ago. But it came down this month to 4.1%. And if you look closely, it's actually 4.055%. So very close to a 4% unemployment rate. So this is going in the right direction now after going up for basically about a year. Again, we want this trend to continue, but we like to see this direction in this report. The next piece of data in this report, average hourly earnings year over year. And this is an interesting chart because if you take a look at this, and this goes back to 2007, first you'll notice from that point to now, the average annual earnings have been around 3.09% year over year. So just over 3% average hourly earnings for workers. This number, COVID really threw things off. If you look at 2020, the scale here, but notice that we came in at 3.97% last month. We'll round that up to 4. That is up from 3.6% just 2 months ago. So we had average hourly earnings coming down for about 2 years, which, by the way, the Fed wanted. The Federal Reserve does not want to see wage growth at 4.5%, 5%, 6%. That is very inflationary. But in the 3s, they're very comfortable there. And so the fact that wages have gone from 3.6% year over year to near 4% in the last 2 months, that is good news for workers. That is more money that they have in their pockets to spend in the economy. All right, now for my second topic today, we are going to talk about the Federal Reserve and the rate cut that they had 2 weeks ago. It was the first cut in this rate cut cycle. They cut interest rates from 5.5% on the upper limit to 5%, so about a 0.5% cut. This is good news for borrowers. Now, it's not so good news for savers. CD rates, for example, will be coming down as a result of this. But it's good news for the economy because a lot of borrowing takes place and spurs on growth, especially for small businesses. And we've detailed that in a number of videos this year. But the Fed, when they announced this rate cut, it came in at 0.5%. Going into the day of the event, a lot of people believed that they were only going to cut by a 1/4 point. They decided, let's go ahead and do a 0.5 point, start off with a bang here, and that's what they've done. Now, as of right now, because it's been 2 weeks, the market, with the strong jobs report of last Friday, is projecting that the Fed's just going to cut rates 2 more times this year, a 1/4 point each. So prior to that jobs report, the market was thinking the Fed was going to come with another 0.5 point in November, but now it's down to just a 1/4. So here is the balance that you have to be aware of with regards to the Fed and rate cuts. You don't want the market pricing in too many rate cuts in the months to come or in the year to come, because that typically happens when the economy goes off a cliff. If the economy is in real trouble, the Fed is going to aggressively cut rates. At the same time, you don't want the Fed keeping rates up at this level because these rates are much higher than they were for most of the last 2 decades. And that makes borrowing very difficult, especially for small businesses. Now, where we stand right now, like we talked about, the market is projecting, and Dan, our editor, can put a line here for you to see, at 4.5%. The market is projecting by the year end 2024, the Fed funds rate to be at 4.5%. It's at 5 right now. That's 2 cuts. By the end of 2025, so looking out about 15 months, the market is pricing in 6 cuts, 3.5% Fed funds rate. So again, we will see what happens as we go through the next 15 months. And again, we don't want too many cuts being priced in. That is not good news for the economy. But where we are right now is kind of a Goldilocks situation. Now, one of the reasons the Federal Reserve was able to cut by 0.5% in September is that the inflation data has continued to come down. Now, if you look at a chart, and we put up this same chart 2 months ago in our August 2nd update, when we did that, the consumer price index, which is on top there, was 2.97. Notice here it is 2.53%, which means year over year, prices have gone up 2.53% is what that means, consumer prices. The PCE, which this is the Fed's favorite inflation measure, was 2.5%, was 2.5%, is now 2.24. And the PPI, which is wholesale inflation, was 2.63. That is now 1.73%. So good news on the inflation front enabled the Fed to cut rates by 0.5%. Now, here's the disclaimer that I have to give every time I'm talking about inflation. You're not crazy when you say, wait a minute, good news on the inflation front, prices are much higher than they were 3-4 years ago. What are you talking about? Yes, we know prices are much higher than they were 3-4 years ago. What we're talking about here is that year over year, the pace that prices are going up with has come down. Prices are never going, unfortunately, prices are never going back to where they were for a basket of goods 3 or 4 years ago. What the Fed's looking to do is they're looking to bring that inflation rate down to 2%, but that still means prices are going up. And so consumers are not happy about that. Now, one issue that I was prepared to address today was the longshoreman strike, but it ended late last week. But I want to mention a couple quick things. Number one, when that strike occurred, JP Morgan estimated that it cost the U.S. economy $4.5 billion per day. So if that had gone on for a long time, that would have hurt the economy in a pretty significant way. The other thing that I want to mention is that the union here was asking for a raise of 77% for their workers over the next 6 years. They turned down a raise of 50% over the next 6 years. That is almost 10% per year. How many of us would take a 10% raise every year? Many of us would jump right to that. So very disappointing to see that the union turned that down and was asking for 77%. That was very unreasonable. And by the way, something else they were asking for is no automation would be allowed in any of their workspaces in the years to come. Again, that is, my view, very unreasonable and one of the reasons that unions get a bad rap. All right, so just to recap, last week was a fantastic jobs report. We looked beneath the hood and found the unemployment rate came down. You had wage growth go up by almost 4%. The components of the jobs gains were very strong and that construction had another good month. We like to see that. We talked about the Federal Reserve and the fact they were able to cut interest rates by 0.5% because the inflation data has improved. We know now that the Fed is expected to cut interest rates 2 more times this year, 6 times by the end of next year, which is good, but we don't want to see more cuts than that priced in because that typically means the economy is significantly weakening. We don't want to see that. One last thing I want to mention is a thank you to those of you who have been watching. We just crossed a nice little milestone of over 10,000 views. And look, we're just doing this for fun and to help clients be more informed, but we still like to see that. Thanks again for watching and take care.